Good afternoon, ladies and gentlemen. We're about to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here with the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session on implied and historical volatility, we'll take a look at how understanding volatility can be one of the most important concepts to investing and how it can help you gain a better understanding for current pricing and its associated risks and rewards. As always, we'll go through today's material in a quick 60-minute session. Our presenter today is a senior specialist with OIC's Investor Services team, Mr. Kyle Graham. If you've ever called our Investor Services line at 1-888-OPTIONS, you may have spoken with Kyle, who has been around the financial markets since 1994. Prior to joining OIC, Kyle was an instructor with the Chicago Board Options Exchange and was also employed by a boutique capital management fund where he was responsible for trading and risk management decisions. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Kyle will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Kyle Graham will bring you our topic today, historical volatility, implied volatility, and your options positions. Kyle?
Nick, thanks for the introduction. Once again, my name is Kyle, and I'm going to present the webinar series Implied Volatility versus Historic Volatility. Now, it was just this week I had a friend of mine call in and say, Kyle, we've been talking about implied volatility and historic volatility over the past couple of months, and it's greatly helped me in my trading and my trading decisions. And I hope that's what it's going to do for you today. Let's go ahead and get started. Now, this slide simply says there's risk involved in trading options. Notice paragraph 2. We're not including commissions, fees, interest, taxes, and all that. It adds a little bit of friction, but for our examples, we exclude all that. Now, OIC was formed in 1992. These are our funding partners that make it possible to give you these webinars. Now, here's 4 questions that I came up with, and at the end of this webinar, we should be able to answer each and every one of these questions. The first question is, why is the concept of volatility important? The second question, what's the difference between historical and implied volatility? The third question, of the two, historical and implied, what do option traders use more? And then finally, what's the market's view of volatility? Now, those last 2 questions will be answered in the third part of our presentation. Now, here's the outline. Essentially, I have a 3-part presentation for you. The last 2 bullets there will be in the third part. The first part, we're going to answer what volatility is. The second part, we're going to talk about the two types of volatility. And then finally, in the third part, we're going to talk about, hey, how does that affect my option prices? How does that affect my trading? And how's this knowledge going to change the way I make trading decisions? Don't you think that would be pretty important to know? I hope so. All right, here's part one. And I'm going to go slow. And much of this information is going to be a repetition. But the point is once you understand this concept, it's very powerful in many of the decisions you make when you're trading. All right, the definition. Volatility is a measure of stock price fluctuation. Notice there, it's a measure of the stock's price fluctuation. So how are we going to measure this? What are we going to use? What's the formula? Well, mathematically, volatility is the annualized standard deviation of a stock's daily price changes. Okay? The number is expressed in a percentage. We use a pricing model, and all that gives us a theoretical value. A theoretical value. Okay? And whammo, there's the formula. This is what we use to measure it. So, where S is the standard deviation, okay, the little s there. Let's start with the top line. If you look at the top line, we start with the sum of, and then the X is each value in the data set. Now, where do we get those values? That's right, we get them from the actual stock price, okay? Then the next value, we're still talking about the top line, the sum of the stock's prices, minus the X with a line over the top is the mean, and we square all that. Then let's move to the denominator, the big N. That's the number of values in the data set. Typically, that's over a period of a year. Some traders like to use the number of trading days in a year, but once again, when we start moving into shorter time frames, as with options, that N number will change to the number of trading days until expiration. But look, don't get upset that you don't know this formula by heart. We're going to go through some very practical ways to determine this using some simple tools. Okay? All right. We're still in section 1. We're still trying to think and know conceptually, hey, what is volatility? We used the formula in the previous slide, and here's what standard deviation is. So notice we moved from volatility to standard deviation, which is measuring the amount of variation or dispersion from the average. Now, from the average of what? That's right, from the stock price's mean. So if somebody goes to you, you go to a cocktail party or something, and somebody says, hey, what's standard deviation? You can succinctly say, it's the average distance to the mean. And that's really all we're trying to find out here. Quite simply, if you look at bullet number 1, a low standard deviation indicates that your data points are going to be very close to the mean. So if you had a $10 stock, let's say your upper data point was 11 and your lower was 9. So the range would be, from 9 to 11. Whereas in the second bullet, a high standard deviation would perhaps give you, on a $10 stock, give you a range of 13 and a lower range of 7. Can you see that? Can you visualize that? So when we're talking about these percentages derived from the formula, standard deviation, we translate that into a range for the stock. All right. Now, once again, we're going to continually repeat many of the concepts that all come from understanding what volatility is. But, once again, statistically speaking, when we talk about one standard deviation, we're talking about 68% of the time that price dispersion will fall into that standard deviation. Now, 68%, 95%, and 99.7% are empirical rules. In other words, what we've seen in the past, empiricism. Or a lot of statisticians use the 3 sigma rule. Why? Because there's 3 percentages there: 68%, 95%, and 99.7%. In other words, one standard deviation is represented by the 68, 2 standard deviations represented by the 95, and 3 by the 99.7. All prices, given the current input, is going to be represented 99 within 3 standard deviations, 99%, 99.7, I should say. So read the bottom there. States that nearly all values lie within 3 standard deviation, which is what that is, and that's the 3 sigma rule. You don't really need to know that, but you do kind of need to remember what 1, 2, and 3 standard deviations are. All right. Just to continue on with what we're talking about, we have here at the end of 1 year, the underlying stock, the closing price, will be within 1 standard deviation, whatever the number the formula spits out, 68% of the time. That's not bad odds. Or within 2 standard deviations, 95% of the time. That's not bad either. And then slightly less than 100, we have 3 standard deviations. How could this be useful to you as a trader, knowing these percentages? How is understanding the likelihood of price dispersion useful when trading? All right, now we've concluded section 1. We're going to go ahead and move into section 2. In section 2, we're going to take the concept of volatility and expand it a little bit to 2 volatilities: the statistical or historical volatility and the implied volatility. Starting with the statistical, which is what we just defined in the previous section, it's the measure, and we know how we measure that with that formula, of actual asset prices, which is what? That's the stock over a period of time. We already stated that, and that's typically about a year. Now, the second volatility, implied volatility. That's the measure, once again, measure of how much the marketplace expects asset prices to move in the future. Now notice the difference between these 2 volatilities. In the first one, historic, does that deal with the past or with the future? That's right. It deals with the past. So if you're taking notes on a piece of paper, you may want to put statistical volatility, or historical, is of course, like it says, past. Now, does the first one deal with the stock or with the option? Just like the definition says, it deals with the stock. In the second volatility, implied, we're talking about the option. The option volatility level, and is that talking about the past or is that talking about the future? Well, that's the expectations, the marketplace expectations. So really it's talking about now and what the market expects in the future. So know those two differences when you talk about these two different volatilities. That's fundamental in understanding the rest of this. Let's move on. All right. So what does it mean when an option's implied volatility is at 25%? Okay, well, we know that volatility is expressed in annual terms, so 1 year period. We can also use the trading days. One standard deviation encompasses price movements, which are about 2/3 of the time, or 68%. And then finally, 2/3 of the time throughout the year, the stock price will be up 25% or down 25%. From what? The current price? No. The mean. Remember what we said about our original definition. It's the distance to the mean. Average distance to the mean. Don't forget that. Next slide. All right. Now this is a very, very practical slide, and it is extraordinarily useful. And these next 3 slides are derived from our website, optionseducation.org. And notice on our website we do have a quote box at the top, and it says quotes. So whatever stock you want to try all this newfound information out on, you can put that stock in that box and hit enter. You're going to get a delayed quote. And once you hit enter, this is what's going to come up. Now all those 4 arrows there, I'm just going to point out 4 different things on this page. There's more than that, of course, but here's 4 important things. One, of course, is you see the stock. Okay. The second thing, the second arrow, starting from left going to the right, is our expiration box. And you'll see the drop-down arrow right there, and it says next to. You can specifically select your expiration month right there. So you don't have to sift through all the months and months and months of option expirations. You can actually select the month that you're looking at. Now the next arrow, the third arrow from the left, points to, I hope you can read that, it says implied volatility. It's in orange. That tells you the implied volatility for each and every option, puts and calls, for all available strikes. Now, sometimes it doesn't populate for way out of the money options, but at the money options, where all the trading happens typically, that's very good at calculating that implied volatility given the current delayed quote. And then finally, the far right arrow is pointing to the scroll bar. And if you move that scroll bar all the way to the bottom, you're going to see 2 icons. And this is on our website. Once again, you can try this out today. You go to the bottom, scroll down, go to the bottom, you'll see 2 icons. One is going to be a price chart, and the other is going to be a volatility chart. Click on those charts, and this is going to come up. There's going to be 2 lines. There's going to be a black line and a green line. The black line represents historic volatility. Now, who can tell me what 30D means right in front of HV? That's right. It means 30 days. That's what it looks back to. It's not 1 year. It's looking at 30 days on the historic volatility. Now, I presume that if that look-back period was longer, using 60, 90, 100, 360, the black line that you see is perhaps going to be smoother. Moving over to the green line, that's implied volatility. Notice there that they're different. One pertains to the stock, one pertains to the options. Notice the spikes on the green line. You'll see 2 prominent spikes and then a couple of more key spikes. How long did those spikes last? A week, 2 weeks, or less? All right? This is for your own analysis. I'm not going to make any inferences for you. This is for your own benefit. You can make your own inferences as we go through this. All right. We're still talking about two types of volatility, and here's an example. Here's a stock at $50. You have 25% implied volatility. Well, if you multiply 25% times the stock price, you get $12.50. You add $12.50 to the stock to get $62.50, or you subtract $12.50 from 50 to get $37.50. Now, $62.50 and $37.50 generate one standard deviation move. Okay, so statistically speaking, 68% of the time, the price is going to remain within one standard deviation between $62.50 and $37.50. But there's a big assumption. The assumption is that implied volatility is an accurate number. Now here's a similar slide to the previous one, but we're talking what? 2 standard deviations. Now what percentage of the time does a stock land in 2 standard deviations? That's right. If you remembered back from an earlier slide, 2 standard deviations is 95% of the time the prices will be within 2 standard deviations. Now what is that? Well, we do simple math here. 25 times $50 stock times 2, $25. We add that and subtract it to the stock. We get a range of 75 and 25. Okay? Once again, the important thing to remember is it's only as good as the input. Now, slide 20 is just a picture of what we've been talking about. This is simply a picture. On the left-hand side, you see the stock price going up. We'll talk about that one first. Stock price goes up, calls go up, all things ceteris paribus, all things being equal. Puts go down. Everybody knows that, right? Stock price goes down, call price goes down, put prices go up, ceteris paribus, all other factors being equal. Okay, we're kind of freezing everything else and we're just talking about stock. Now, let's go to the right 2 pictures. Volatility goes up. What happens to my puts and my calls? All other factors frozen in time. Volatility goes up. My puts and calls are going to go up. Wow, isn't that just a great revelation? Now, in that, we're going to focus on this real quick. The increase in volatility is going to increase what? Yeah, I kind of have to know a little bit about option premium, and I don't want to get too much into this, but there's 2 parts in an option premium and intrinsic value and time value. This is really going to affect the time value. Now, moving down to that final picture there, volatility goes down. All other factors being equal, decrease in volatility, call price, put prices are going to go down. Now, what happens when you have the stock price going up and the volatility going down? Or stock price going down and volatility going up? That's a good question, right? Well, lo and behold, you don't have to guess. On our website, we have the option calculator. What a great tool. And it can do all the math for you. All you have to do is put in some of the inputs. Some it'll actually put in for you. On the left-hand side, on the picture in front of you, you're looking at all the inputs. There's 6 of them. Today, what are we concerned with? Well, today we're concerned with the volatility percentage. Notice there, if you can see in the slide, it's 25. Also note that we're dealing with an option that expires in 26 days. If you can see that, just remember we're dealing with about a 1-month option. All right? Now at the very bottom, there's the calculate button. So once you put in your number, you click calculate, and that's what you're going to get in the call and the put column. So let's not concern ourselves with the delta, gamma, theta, vega, and rho. That's in another presentation. But let's look at the value. The call value and the put value. That's what it's going to generate. That's that formula, and it does it all for us. We don't have to know any special math. We just have to know where the option calculator's located. Now, one thing I want to bring your attention to on this slide is, what would a straddle be worth? Well, what is a straddle? Buying a call, buying a put, same expiration, same strike. When you add those two numbers together, you get $2.69. And if you applied that to the stock price, you could get a range of $47.31 and $52.69. Now, once again, I'm not going to tell you how to trade or what this means, or go long here or sell here, but just understanding kind of what the market thinks and giving yourself a range of a 26-day option with a straddle is a pretty good thing to have a good estimation of prior to or during the trade. All right. Now, all this slide is saying is, back in the formula I gave you way back when, we can adjust the time factor, and that's what you see, where you see the 26 days divided by 252 trading days in a year, and that's all that is. So don't get wrapped around the axle about this. I'm just saying that the number of days is going to affect the standard deviation, one standard deviation move. All right, so we've waded through section 1. We kind of came out of the swamp there and we got on dry ground in section 2. And now in section 3, this is where we climb the mountain and say, hey, we're going to use what we've just learned. Very practical information. Factors that change volatility. All right, so what factors influence implied volatility levels of options on any given stock? Supply and demand ultimately rule in the market, the buyers and sellers, right? And when buyers and sellers interact, they create an option price, and the decisions that they make are perhaps on certain factors in the market. It's not always the case that they react in a predicted manner either. But here's some of those factors. Here's some events that are going to happen in the future. How about market sentiment? Would that change supply and demand? Would that change the buyers and sellers of options? How about fundamental changes in a company? People know that these changes are going to happen. That may influence or may not influence the buyers and sellers in the option marketplace. Also, economic factors, market psychology, takeover rumors, the actual changes in the stock's volatility. And we saw a chart on that. Also, revisions in earnings estimates, and that's a big one because we know that earnings have a big impact at times on option prices. All right, so these factors that perhaps change volatility, implied volatility, are they good or bad for you? Do we want this to happen, or do we want it to stand still? Well, are you long or short options? If you're long options, typically you want increasing volatility. If you're short options, you want decreasing volatility in conjunction with other factors like favorable price changes. All right. How do option traders use this implied volatility to make a decision? Well, it may give you an objective way to test your forecasts, and you're not coming up with numbers out of the blue. It may give you a possible entry or exit point if you know ranges on stocks or the higher or lower numbers relatively speaking. Okay, you can even calculate ranges, highs and lows of stocks. Not saying it's actually what's going to happen, but it may be helpful to use. You can compare these implied volatility numbers to your own outlook, or even measure a potential risk and reward relationship. All right. Forecasting. Forecasting implied volatility. Do people actually forecast implied volatility? Well, they sure do. If you forecast that your volatility is going to go from low to high, what strategies are you going to pick? Spreads, collars, condors, covered calls? Or what if you forecast your volatility is going to go from high to low? What strategies will benefit from that? All right. So we know after all this, talking about all this business about implied volatility, this doesn't affect your positions. And once again, we saw back on slide 20 that picture shows you a little bit about those factors that influence option premiums. Is it high, relatively speaking, for call premium? Or is it high, relatively speaking, for put premium? Well, we can kind of gauge this with implied volatility. And this lets us know what buyers and what sellers kind of think about current prices or even the future. All right. Now here you go. This is a good slide. Talking about, let's just read this together. Investors who are not focused on volatility are frequently motivated by an overriding opinion about an underlying stock price and an option's intrinsic value at expiration. So what did this guy do? Was he focused on volatility? No. Was he focused on the stock's price? Yes. And when did he say that the stock price was going to move in his favor? That last word, yes, expiration. And many investors using options have that in mind. So the changing implied volatility, without considering it, may be unexpected. So you bought a stock at 50 and you sold a covered call, and you say, hey, why did my covered call react that way to changes in implied volatility? Well, after knowing this, you kind of see the background to those premiums. All right. This is just a little summary here, and just kind of want to hit this again. Just this is the key. Volatility represents underlying stock prices fluctuation. We're talking about historic, right? Not trend. In other words, if a stock starts at $50 at the beginning of the year and ends at $50, it didn't mean that it didn't have zero volatility. It just meant it didn't trend at the end of the year. The second bullet there, we measure it with standard deviation, and it represents the market consensus. Also, it can decrease, changing your put and call prices. It can increase, changing those prices. And then also, it's dynamic. Now, we saw that in the green line way back when, that it can change during the option's lifetime by the month, week, day, minute, and yes, second. It is dynamic. It does change. All right. Buying options that are undervalued or overvalued, it doesn't guarantee a profit. Why? Because if you say things are overvalued, we're not saying they're going to go back to the mean. It's not necessarily going to go back to the mean. Can it go higher? So if you say, boy, that's a high implied volatility, can't that go back even higher? Or can it go back to the mean? It sure can. Once again, you have to have a good idea of kind of what's going on in the background. Now, at this point, you may say to yourself, wow, why not just trade volatility? Forget price. I think volatility is more predictable. Or you say, I don't know. The thing to do is familiarize yourself with the implied volatility levels. And I showed you how to do that practically from our website. And I'm sure many of your brokerage firms provide that information as well. Also, develop a comprehensive understanding of how prices work. Now, once again, that would be in a different class talking about the option Greeks, but that is key information. All right, so remember, implied volatility is a collective forecast. And who's it collective of? All the buyers and sellers. All right, so do you have an opinion on implied volatility, or do you not have an opinion on implied volatility? Hopefully, if you have positions out right now, you'll go back and look at implied volatility. Or if you don't like the current implied volatility levels, you say, boy, that's too high for me, then you may want to wait. But in either case, when you trade options and you go into the market, you're accepting the theoretical distribution of future underlying prices predicted by volatility. All right, here's the conclusion. We talked about in section 1 what volatility is, the two types of volatility, and we compared those and the effects that it has on your overall positions or the market. This concludes my presentation. Thank you.
Kyle, thanks so much for your expertise today. I think we had a lot of good information there, and I can tell you we got a lot of questions today as well. Before we get to them, ladies and gentlemen, I do want to remind you that if we're not able to answer your questions today, you can always give Kyle and his colleagues a call at 1-888-OPTIONS, or you can visit optionseducation.org to connect with our options professionals here at the OIC. With that said, Kyle, do you have any favorite strategies for when volatility goes up and favorites for when volatility goes down?
Well, that's a good question. And you know, what I think is, going back to the one slide where you talk about familiarization with this, you make your own inferences. As far as my favorite strategies go, I do like to look at the at-the-money straddle in whatever month I'm trading, because that gives you a good idea of kind of what the market thinks. And you know, the market, you know, perhaps it's right, perhaps not. But the thing about the trader is, you know, the good investor, the good trader, is he wants to really be familiar with that market. I remember working for a trader. He traded one product, and he was really, really good at it. And I remember he'd call me from his cell phone in his car, and he would tell me, without even looking at the market, the range where he thought the market was, and I was always astounded at how close he was. So as a trader, you're using those numbers to get a good idea as to the characteristics of the market you're trading.
Kyle, what does it mean when the implied volatility is over 100%?
boy, that means you've got a really crazy stock on your hands. No. Remember that this is relative. I remember looking at some stocks where if you saw implied volatility of 100, you thought, why is it so low? Because normally it was like 150. Now that's back in the day when the VIX was, in the 30s and 40s. So we've got a low VIX number right now, and there's products out there that focus on volatility. But right, you've got to know your market. You just can't make a ballpark decision based on one stock. If you're looking at one stock, know that one stock. But you can't compare your stock's volatility to like the S&P's volatility because those are two different animals.
Kyle, let's step back towards the first part of your presentation when we were talking about kind of the theoretical underpinnings of volatility. Why were you using a standard bell curve to explain standard deviation and therefore volatility? Can you go back to that and speak to that a little bit?
Well, let me just say that we used a normal distribution of prices, and I don't want to go into this because this is really beyond the scope. Instead of the log normal, if you don't know what that is, don't worry about it. But for this presentation, we wanted to use the normal distribution. Now, many traders use the log normal distribution, and we don't want to get into kurtosis and the fatness of tails and all that. You can do that on your that's your homework if you want. But for the sake of this presentation, we just wanted to talk about volatility and the concept. As far as the advanced math and how to program some of your trading platforms, once again, that's on you, and it can get very complicated, I will say, but that's part of the enjoyment of trading to many people. They enjoy putting all that in there.
We had a few very advanced listeners who were familiar with the Greeks as they pertain to options, and this listener wanted to know if a stock's volatility and beta value are related.
Well, once again, I'd say that's beyond the scope of this presentation. One of the things I want to emphasize, and we can really get up there in some of the complexity of the questions. One of the things that you really wanted to remember, there's no right or wrong. What you're doing is you're taking the market and these numbers. Say you take beta, say you're taking volatility, and you do your research or do your computation. You're trying to come up with how you're going to react, and maybe you see something that nobody else does. Maybe you see, when you make the correlation between implied volatility and beta, that you disagree with the market. But that's the point. You take this information in, and that's where you reap the benefit of being a good, astute, calculated trader.
We wanted to know a little bit about very technical and applicable situations for some of these things. This listener wanted to know if it's more important to do a technical analysis of the underlying security, or is it more important to do your analysis on the volatility, on the implied volatility side, if you're thinking about selling a call. Can you speak to that a little bit?
Well, sure. Technical analysis, as opposed to fundamental analysis on the stock is what it is. You will talk to 10 people. 3 will say that the Japanese candlestick dojis are neutral or represent a springboard effect to future movements of prices. To that, I couldn't say. That's really not my expertise. But if you're using a technical analysis and you have a forecast on the underlying, once again, we're talking about stock prices. Whereas if you're trading an option on the underlying, wouldn't you want to know both? So yes, you want to do, if you use technical analysis, you want to have a forecast on your stock, and you want to have a forecast on your implied volatility.
Kyle, is implied volatility more important to a specific type of options, or is historic volatility more important to a specific type? If you're looking for a specific type of call, should you be looking at one or the other, or should you be looking at both?
I'm not sure I followed that question, Nick. Can you say it again, please?
Sure. The listener asked if implied volatility is more important to a specific type of an option, say an iron condor, for example. Would you look at implied volatility in that situation, or would you look more at historic?
Well, remember what we said about historic. It's pertaining to that black line on the chart comparison is pertaining to the stock. So whether you see a difference between implied or historic, that's up to you, the trader. Is implied volatility important? When you're placing a specific type of strategy, yes, it is. And I would say that, when I first started in this business, I want to know all these strategies. But the best thing an investor can do, or an option trader can do, is know his or her respective strategy very, very well and become an expert on it. If that morphs into another strategy, then so be it. I mean, I've read some guys who trade condors, and they've calculated it out where they're going to put the condor on and lift it three quarters of a way into the trade. That's up to them. That's the way they do it. But the bottom line is they know their strategy. They know the effects of price on their strategy over time. They know how the prices are affected as it gets closer to expiration, and how sensitivities of these factors increases in closer to expiration. Whereas if you're trading leaps, a lot of these sensitivity issues, such as the Greeks, we don't want to get into that, but they're just less sensitive on leaps.
Kyle, why is it that both call and put prices both go up when implied volatilities increase?
Well, just think about those factors. We know that, let's say we know earnings are coming out for a stock. A lot of times, there's a perceived addition of risk in this, because earnings, we don't know what earnings are going to be. So when there's an increased level of risk, the sellers want to be compensated for increased risk, right? Just like you buy car insurance. Well, if you're insuring an 18-year-old, it's going to be different from a 40-year-old. I mean, I hope. If it's me, I'll probably be paying the same price as the 18-year-old, but that's neither here nor there.
Kyle, is there a way to look at either implied or historical volatility and determine if an option is either over or undervalued?
Well, once again, you're trying to become familiar with that. So if you went back to, let's say you went back to our website, you pull up your, you put in your stock ticker, and you go down to that little chart of implied versus historic, the 30-day historic. Your own inferences may be, I see some, I see something where you have some kind of spread on the two. I mean, I don't know. I'm just kind of saying you're going to apply your own analysis as to those two numbers, and whether there is divergence between implied and historic. That would be pretty interesting to look at specifically, and then make a forecast not only on the implied vol but also on the underlying price.
Thanks, Kyle. Well, we are coming up on the end of our presentation, ladies and gentlemen, but we do have time for one more question, and I think it's a great one for Kyle to go a little bit in depth on as a member of the Investor Services team. Kyle, we got a number of people wanting to know on the OIC website, where can they find these volatility charts, how can they view them, and what do they need to do to get all this information you talked about today?
Oh, well, that's simple. That's on optionseducation.org, and that's the slide right in front of you, optionseducation.org. Once again, there's a quote box up there. You type that in. And, you know, for many people, if you've already got a trading platform that you use, a lot of this information is available real time. It's not a delayed quote. But on our website, if you're going to use it, and I hope you do, because I do think it's one of the easier sites out there to use. You just get that quote, scroll down to the bottom, click on that slide, and boom, it pops up, and you're good to go. You can do all the analysis you want.
Thanks so much, Kyle. Do you have any closing remarks for our listeners today?
Well, I would like to say, Nick, that you know, trading's a process, and a lot of people are looking for a black and white answer, but it's a process, and the market, sometimes the fundamentals of the market changes over time. So you kind of want to do what my old boss used to tell me is enjoy the process. And I remember that same boss used to come every month, and he'd have his 400 stock charts, and he would know the earnings of those. And then I had another boss, trading guy. We would come in every morning, and we would look at various index spreads. So whatever process that you're using, you want to have a process, and I hope that this presentation will give you an additional thing to think about in your own process.
Kyle, thanks so much for your expertise and time today. Ladies and gentlemen, as he mentioned, the position simulator is available under the Tools and Resources dropdown on the OIC website, and make sure to check out our tools through the quote chart as well on our website. Thank you so much for your time this afternoon, and as I mentioned, if we weren't able to get to your question, our Investor Services desk, which includes our friend Kyle right here, is always ready to help at 1-888-OPTIONS. Give him a call during most business hours at any point. We'll be holding our next webinar on August 19th, which will be the third session we've offered on the topic of position adjustments. That one will be hosted by Joe Burgoyne. Please check optionseducation.org in the upcoming weeks, or keep an eye on your email for a sign-up link. Many of you have asked if these webinars are archived. They will be available through the On24 on-demand system. Use the same link that you used to sign up and attend today's session, and you'll be able to see an archived version of today's session. Thank you so much for attending, and we hope to see you again next time.